All right, so get this. Today we're diving deep, deep into the world of monthly dividend stocks. You know those investments that just shower your portfolio with a little cash reward every single month?
Like a little bonus paycheck.
Exactly. Who wouldn't want that, right?
Indeed, and for this deep dive, we're focusing on specifically two REITs that fit the bill. Real estate investment trusts, that is, we're talking EPR Properties and STAG Industrial.
Okay, REITs. Before we get into the weeds, can you remind us, for those who may have forgotten, what makes REITs so special, especially for someone looking for those monthly dividends?
Absolutely. So REITs are companies that own, operate, or finance income-producing real estate. And here's the kicker. They're legally required to distribute at least 90% of their taxable income as dividends to shareholders.
So basically, they're designed to, like, share the wealth, literally, right?
Precisely. That's why they're a favorite for investors who are really focused on that income stream.
Now, our source material for this deep dive, it comes from a Motley Fool article dated February 15th of this year. And get this, one of these stocks is boasting a 7.1% dividend yield.
Whoa.
Now, I don't know about you, but that's pretty tempting, right?
It definitely grabs your attention. High yields like that, though, sometimes, it's a little bit of a warning sign.
Yeah,
Could be some underlying risks we need to unpack.
for sure, for sure. So let's kick things off with EPR Properties. That's the one with that juicy 7.1% yield. What kind of properties are they holding that, justifies such a generous payout?
Well, their name used to be Entertainment Properties Trust,
Interesting.
so that gives you a pretty good hint. They specialize in what they call experiential properties.
Experiential properties. Okay, now for those of us who don't speak, Wall Street lingo, break that down. What exactly falls under that umbrella?
Think about places where people go for more than just a simple transaction. We're talking amusement parks, movie theaters, ski resorts, even Topgolf locations. Those venues where folks go for an event, a social gathering, a memorable experience.
Yeah, so the thinking here is that even in our digital world, people still want to get out there and do things, have those real life experiences, right?
Exactly. It's like investing in that very human need to escape the screens and actually get out there.
But didn't they take a big hit when the pandemic happened?
Ooh, yeah. Big time. That reliance on in-person experiences really made them vulnerable when everything shut down. They actually had to suspend their dividend payments for a whole year to survive the storm.
Wow, that's got to hurt. I mean, especially for those investors who are depending on that income.
Yeah, definitely not a smooth ride for them. So, risky? Maybe.
Yeah. So how has their recovery been? Are they back on track or is it still a bit shaky?
It's kind of a mixed bag, to be honest.
Okay, good.
On the one hand, they have reinstated the dividend, and they're working towards growing it again.
Okay.
But there's a catch, and it's a big one. A huge chunk of their rent, we're talking over a third. It still comes from, guess what? Movie theaters.
And movie theaters have been struggling, to put it mildly, right? So EPR is basically hanging on by a thread, hoping people go back to the cinema.
Well, it's not quite that dramatic, but it's definitely a concern. Their rent coverage from theaters, which basically means, how well those rent payments cover their costs.
Yeah.
It's actually lower now than it was before the pandemic hit.
Oof, that's not a good sign. But didn't you say that some of their other properties are actually doing really well? Could that be sort of their saving grace?
Yes, that's the interesting part. The rest of their portfolio, which includes things like, those Topgolf places, water parks, those kinds of entertainment venues, are actually doing better than before the pandemic. So they're diversifying, right? Moving away from those movie theaters.
So are they in turnaround mode or is it, too early to tell?
It's a story that's still being written, but there is another point that has some investors worried. It's their FFO.
Okay, hold on, time out. FFO, for those of us who aren't real estate experts, what is that?
Right. It's funds from operations. Think of it like a company's net income, but specifically for real estate. It's essentially the cash flow generated from their properties.
Okay.
And, well, EPR's FFO, it's actually down compared to last year, which can spook investors, understandably.
Yeah, that makes sense. So maybe that explains that sky-high dividend yield. It's like they're trying to lure investors in with a big flashy number to distract from maybe some of the risks.
Could be. Now, the question is, how sustainable is that 7.1% yield if their FFO keeps shrinking, right?
That's the million-dollar question. What's their payout ratio looking like? How much of that FFO are they actually paying out as dividends?
So their FFO payout ratio, it's currently at around 66%, which is, generally considered a healthy range.
Okay.
It means they have some wiggle room, but yeah, definitely a situation that needs to be watched closely.
Okay, so let me get this straight. EPR Properties, high yield, high risk, and a potential comeback story that's still, up in the air. Got it. Now, let's shift gears and talk about STAG Industrial. From the name alone, they sound a little, I don't know, more grounded, right?
I think that's a fair assessment. Yeah, STAG focuses on those industrial properties, warehouses, manufacturing facilities. Not as exciting, maybe, but potentially more resilient in, uncertain times. And their net lease approach, that means the tenants cover most of the operating expenses, adds another layer of stability.
So while EPR is like betting on people's desire for fun and thrills, STAG's banking on the essentials, the stuff that, keeps our economy running. Interesting contrast. But how does their dividend history stack up? Can we even come close to EPR's bold 7.1%?
Well, bold might not be the word I'd use for STAG. They're a relatively young REIT, but they've consistently increased their dividend every year for over a decade.
Wait, every year? Even during, like, the pandemic craziness when EPR had to hit pause?
Yep, that's right. So, their growth may not be as flashy, averaging just under 2% annually over the past 10 years. But that consistency, that's really a big plus, especially for those who are all about reliability and that steady income.
So it's like the tortoise and the hare, right?
Exactly.
EPR is sprinting for those big returns while STAG is, slowly and steadily building that track record of dependability. But who's drawn to these industrial properties? They don't exactly scream exciting investment, do they?
Right. Well, STAG, they target what they call second-tier markets.
Second tier.
Yeah, so think smaller cities, regions where there's less competition and often, better deals.
Ah, so they're kind of playing the real estate game differently, finding those hidden gems that maybe others overlook.
Exactly. Less glamorous, but it can be very effective.
Smart. But does it actually translate into good returns for investors?
That's what we'll be looking into next. STAG's approach, well, it's allowed them to generate steady returns, and their dividend growth, although modest, has been incredibly consistent.
Okay, so we've got our two contenders, EPR, the high-risk, high-reward player, still in that turnaround phase, and STAG, the steady Eddie, the lower yield option. Really interesting. It's making me think, which of these actually fits my own investing style?
That's the key question, isn't it?
It is, and we'll tackle that big decision right after a quick message. Stay tuned.
And we're back.
Before the break, we were talking about, our two REIT contenders, EPR Properties, the high-yield risk taker, and then we've got STAG Industrial, the slow and steady tortoise, I guess you could say. But, which one's the right investment?
Well, that's the question, isn't it?
It is. It is.
It really all boils down to your personal goals, right? And your risk tolerance. So to help you figure that out, let's fast forward 5 years into the future. What does the world look like? And what kinds of properties are really thriving? Are we all rushing back to those in-person experiences that EPR is counting on? Or have we, fully embraced the digital world, making STAG's warehouses like the backbone of everything?
Ooh, I like that. It's like we're gazing into a crystal ball here, real estate crystal ball.
Yeah.
So, on the one hand, you've got this basic human need to connect, to go out and do things, experience things in real life. After those pandemic lockdowns,
Right.
I could see how people would be craving concerts, theme parks, even, just a night at the movies that could make EPR's properties really hot.
Definitely. And let's not forget, the whole rise of experiential retail. Traditional stores, they're having to get creative to pull people away from their screens, right? So we're seeing those shopping malls turning into entertainment hubs with, arcades, escape rooms, fancy food halls, all that jazz.
Right.
EPR, they're in a good spot to take advantage of that.
But there's also the whole, convenience is king argument. Online shopping, so easy. And as delivery services get even faster, more efficient, who knows? Maybe we'll be ordering our groceries from drones, right?
Yeah.
Landing on our balconies, who needs to leave the house?
Right. And in that scenario, those warehouses, those distribution centers, all those logistics properties that STAG focuses on, they become absolutely crucial.
The unsung heroes of our, daily lives, right?
Absolutely. The growth of e-commerce and that whole demand for fast delivery, it's turned industrial real estate into a very, very hot sector. And even though STAG focuses on those, second-tier markets, they're not immune to these big global trends.
So maybe it's not really an either-or situation, right?
Right.
Maybe both EPR and STAG, they both have a shot at, doing really well in the future.
Exactly. It's not just about numbers, right? It's about understanding kind of the bigger picture, the economic forces that are shaping, how we live and how we spend money.
Yeah, and trying to predict where things are headed. It's
Right.
like it's like we're peering into the future, trying to make sense of it all.
Exactly.
So on our crystal balls might be, a little foggy,
Sure.
but that's what makes this so exciting, right? There's no easy answer. But this deep dive, it's giving us the tools to at least, start thinking about those decisions.
Absolutely. And, it's important to remember those key takeaways. So with EPR, we're looking at potential for, high returns driven by the resurgence of those in-person experiences, right? And their efforts to move away from those struggling sectors like movie theaters.
Yeah.
However, they are dependent on consumer behavior, which means, vulnerable to economic downturns and those changing preferences we were just talking about.
Right, right. And then there's STAG, the reliable one. They're focused on that, essential infrastructure, the things that keep our world running, and that focus on industrial properties and essential businesses means they're less exposed to, those whims of consumer spending.
Exactly.
Plus, they consistently increase their dividend even during like tough times. That's got to be like a huge draw for investors who are looking for that reliable income, right?
Absolutely. And, their strategy of focusing on those under the radar markets gives them a competitive edge, allows them to, potentially buy properties at better prices. It's a less flashy approach, but it's proven to be effective.
So it's like EPR is the exciting startup, right? With a groundbreaking idea, tons of potential, but also a high risk of, things not working out. And STAG is the blue chip company, maybe not as sexy, but known for being reliable, steady growth, all that.
I like that analogy. And it really highlights how important it is to, match your investments with your personal risk tolerance, your financial goals. So are you someone who's comfortable with, riding those waves of volatility for a chance at those big returns?
Right.
Or do you prefer a smoother, more predictable path?
That's the question. And you know what? We're going to help you figure that out right after this. Okay, so we've journeyed through the world of monthly dividend REITs, right? We've got our contenders, EPR properties, the high yield daredevil, and then STAG Industrial, building that slow and steady foundation. But now, like, how do you, the listener, decide which one's right for your portfolio?
That's the real decision point, isn't it?
Yes.
It's great to, understand the companies and all that, but what matters is, like, what do you actually do with that information?
Exactly. So break it down for us. What questions should our listeners be asking themselves when they're comparing, EPR and STAG?
Okay, so first things first, think about your timeline. Are you in it for the long haul, saving for retirement maybe, or are you looking for like shorter term games?
Right.
If it's the long game, Stag with their consistent dividend growth, that might be more appealing, right? They're the steady friend who's always there for you.
Makes sense. Makes sense. But what if you're the kind of investor who, likes a little more excitement, a bit more risk for the chance of a bigger win?
Well then EPR might be more your speed if you really believe in, those experiences that they're going to make a big comeback, that growth potential could be pretty attractive. But remember, you got to be comfortable with, some ups and downs.
Higher risk, higher reward, as they say.
Exactly.
So timeline, risk tolerance, those are big ones. What else should we be thinking about?
Think about your income needs, right? Are you relying on these dividends to like pay the bills, or are you reinvesting them, to grow your portfolio even more? If you need that steady cash flow, Stag's predictability, that's a big plus.
It's like a safety net almost.
It is. That consistent income stream can be really, really valuable.
It makes me think about, diversification. You always hear like, don't put all your eggs in one basket. How does that apply here?
Diversification is so important. No matter how you invest, even if you love EPR, it's wise to balance it out, right? With other more stable investments. Don't go all in on any single company, no matter how promising it seems.
So it might not be about picking one winner, right?
Right.
Maybe it's about finding like that balance.
Exactly.
That's right, for your specific situation, your goals, risk, your whole financial picture.
Exactly. And remember, investing, it's not just a one-time thing. Your needs can change, your circumstances, your portfolio. It should change with you.
It's a journey, not a destination, right?
Exactly. It's about crafting a strategy that really reflects you, your values, your goals, all of that. It's pretty cool when you think about it.
Yeah, as we wrap this up, I'm thinking about how like EPR and STAG, they represent such different ways of thinking about investing. One's chasing those big splashy returns. The other one's, building that solid foundation piece by piece.
And both are valid, Depends on what works for you.
Exactly. And hopefully this deep dive, it's given you the the knowledge you need to make that decision, to feel confident about it.
We've explored the world of monthly dividend REITs. We've gotten to know EPR Properties and STAG Industrial. We've even, tried to peek into that real estate future.
But like always, the most important thing, do your own research, right?
Stay informed. Keep learning.
Keep learning. The world of investing, it's always changing.
Always.
The more you know, the better decisions you'll make. So on that note, we're going to sign off. Until next time, happy investing, everyone.